Welcome to our coverage of the Bank of England's monetary policy decision. And as many of you probably already know, they decided not to do anything. Now, I think that the actual interest in these meetings isn't so much as what they do, 0.25% up or down. It's more about the economic insight you get and also an idea about what's in their mindset about what they're going to do in future. What's the path of policy and what's going to drive that. So that's what we're going to dig into today. But starting with the vote, it was 8-1 to maintain the bank rate as it is. So uh, almost unanimous. Swati Dingler was the only one that was actually voting against. She wanted to cut by 0.25%. And so rates are still at 5%. They were cut in August for the first time for this cycle. So we are on a downward trajectory, but it looks like it's going to be a very gradual downward trajectory. If we have a look at the actual rate compared to history, and we can actually just zoom in on that. So here you can see relative to history where we are right now. We have had this incredibly aggressive increase, but it looks like on the way down it's not going to be aggressive, it's going to be very gradual. So if you're a saver, that means that if you've got a money market fund, say, it'll carry on paying 4.95%, which is where we are now, and that'll carry on until the next rate decision, which is in November, when there probably will be a cut. I think that's the kind of consensus now. But it will be quite gradual. So it'll only fall by steps of 0.25. There aren't going to be these 0.5% cuts like we saw from the Fed yesterday by the sound of it. So it seems as if it'll be gradual. So if you are a saver and you've got a money market fund, there's no massive rush to move out of those. It's still the case that they're generating more income than, say, most of the gilt yield curve. So that's why I really wouldn't panic and move out of those and lock in a rate at a lower rate yet. So a gradual set of cuts from where we are. And yes, we're at the median over the last 400 years. So this rate that we're seeing right now is just normal. It's just that we've come off a period of very low interest rates that it feels abnormal. Now, if we look at markets and the market reaction, it's interesting that you might expect, given that the Fed cut rates by 0.5% yesterday and the Bank of England didn't do anything, because currency is driven by interest rate differentials. If I move to the interest rate to the sterling versus dollar graph, given that the US cut rates, the Bank of England didn't, you'd expect sterling to strengthen. But in fact, there wasn't a huge change. It was just quite volatile yesterday around the 50 basis point cut. In overall today, yeah, sterling actually weakened a bit. Strengthened overall during the day, but weakened as the announcement was made. So not a huge movement in the currency space. And often if there's a surprise, that's where you see the shock. But clearly, markets expected there was a 30% chance of a cut, 70% chance that there wouldn't be a cut, and markets weren't surprised. It was pretty much priced in. If you look at the a gilt ETF for the UK, you can see that there was a fall in the price of gilts as reflected in the price of this ETF. So the price fell, yields rose, but not a huge amount. So, a fairly modest fall. So no big shocks for markets. A lot of this was already priced in. This is what markets were expecting. And I'm not going to read that, don't worry. I'm just going to paraphrase it. But there was an interview with Bailey. And of course, this is one where we don't get any monetary policy report. And we also don't get a press conference. So you just have to take what you can get. And Bailey was interviewed by Bloomberg, and he said some interesting things. Firstly, he pointed out one of the numbers, which is services inflation is still elevated. Remember how important that is for the UK. Services makes up 80% of our economy, so if services inflation is high, that's a big deal, and it's a really important driver of UK inflation overall. But he did say, I think we're on a gradual path down. That's good news. I think interest rates are going to come down. I'm optimistic on that front, but we do need to see some more evidence. So this kind of reflects what Powell was saying yesterday, at the Fed press conference, which was about patience and waiting till you see really clear evidence that inflation's falling before you move. And that's clearly what Bailey was getting at here. So patience for us as well. And he's talking about shocks in the economy. He's saying both shocks have now passed through the system. It's good news that they've left fewer aftershocks than many of us had feared they would. Inflation has come back very near to target, because the big worry, of course, was that inflation would be persistent and it would take a very long time for inflation to get back to 2%. It has taken quite a long time, but less time than the Bank of England thought it would. And he said, we seem to see that sort of residual element now fully taken out. So even that tiny bit above the 2%, currently the latest print for inflation in the UK was 2.2% for CPI inflation. We'll see those numbers in a minute. So that we're sustainably back at target. I'm optimistic, and I think rates will come down further. So yes, they're heading down, but gradually. And then Bailey said, we've got 2 more meetings left this year, one in November, one in December. We'll obviously take each meeting at a time. We'll judge the evidence. They always say they're data dependent. And we'll be doing a full round of forecasts and a report and a press conference in November. So we'll judge all the evidence as it comes in. The usual, data dependent, right? So the thing he focused on was that service inflation data. Now, the thing which he didn't mention, but which is probably very relevant, is this, which is Labour's fiscal plan. Because we're going to get a budget, and that's going to be on October the 30th, according to the Office for Budget Responsibility. And that presumably is not going to be very generous when it comes to spending. In fact, Labour keeps harping on about the 20 billion black hole in the budget, which they miraculously discovered, even though if you read Andrew Johnson of the Institute for Fiscal Studies, if you listen to his thinking, he'd been pointing out this gap in finances for some time. And he said if anyone was willing to look, they'd have seen the gap in the budget. So, but this really strict adherence to debt to GDP falling over the 5-year forecast horizon is going to limit how much the government can spend. Less government spending means less growth. So I think Labour's fiscal stinginess is going to actually get growth down and do a lot of the work for the Bank of England. At least that's what I'd expect. That's probably what's at the back of their minds. Now, if you ask the MPC, they will say that they don't take fiscal plans into account, at least not in a forward-looking way. But I think that's probably part of their thinking right now. But we will get the forecast from the OBR, which will be really interesting just before that, on the day that the budget comes out. So we'll see what the government's going to do. But it feels as if the constraints they've set themselves are just not going to allow them to stimulate the economy. And we're actually going to see what looks very much like an austerity budget with a Labour government because of their self-imposed spending constraints. So I think that's probably going to make the bank wait until November. It's a November meeting to see exactly what the government's going to do and then adjust their policy accordingly. And if it is a budget which doesn't look very generous, if it is an austerity type budget, austerity light you could call it, then they won't have to do so much. You know, they won't have to keep rates as high. So presumably they'll be able to cut sooner. If that's the case, if the weakness in the economy comes from the government's fiscal plans rather than their monetary stimulus. So maybe that'll make rates fall more quickly. So now let's look at the high and sticky services inflation. This is the thing that spooked the MPC this time around, I think. And if you break down UK inflation into goods and services, goods are still in deflation. So we've got falling prices year on year for stuff, stuff that you buy. But services inflation is still very elevated. Not only that, but while goods inflation fell, so it's in negative territory and it got deeper with the latest print, Services inflation, I don't know if you can see it on the graph, it's only sticking up a tiny bit here, but it actually ticked upwards. And I think that's worrying for the Bank of England. But even the trend, if you look at the trend and ignore that data point, you can see how slowly it's been falling. The disinflation in services is much less marked than it was for goods. So that is worrying because of the size of services for the UK economy. So we'll talk about scenarios in a minute when we talk about the minutes, but that is a problem, and that's probably going to make our cutting period for the easing of policy in the UK. It's going to make it much longer and much more gradual if it persists. And also, if you break down inflation according to different components, notice how energy is the biggie. Energy was the culprit, which was pushing inflation up in 2022, and it's now pulling in the opposite direction. It's pushing inflation downwards strongly. But the component which is still there and still large is services. It started to increase in April of 2022. It's been gradually increasing, and it's only had a tiny bit of disinflation since June of last year. So still very little sign that services inflation is abating. While non-energy industrial goods, that source of inflation is falling. Food is falling, so you can see the red bars here are squeezing down. And of course, energy's gone into reverse. So that is the sticky component, and that's what spooked the Monetary Policy Committee. So if you hear at the dinner table someone saying, inflation's fallen to 2, why don't they cut rates? That's why. So if we break into core and headline CPI, you can see that as well. Core CPI is 3.6. CPI with energy, food, alcoholic beverages and tobacco is falling. It's just a shade above 2%, but core CPI is actually ticking upwards at the moment for that reason. And if we break it down into components, you can see that further. And if we compare the UK's inflation with other developed countries, notice how currently we're kind of middle of the pack. So we're below the EU average of 2.8%. We're in line with France, 2.2%, a bit above Germany, and well above an equivalent measure for the US, which would be 1.3%. So in the kind of global scheme of things, we've got reasonable inflation. It's not particularly sticky compared to other countries. It took a long time to come down because of the energy price cap, but now headline inflation is kind of middle of the pack. So now let's turn to the minutes, and I think this is where you kind of get an understanding of their thinking. And one of the things which Ben Bernanke asked them to do is create scenario type approaches to their thinking. So we're going to do 3 scenarios that they mention in the minutes. I've given them my own name just to help me think it through, and maybe it'll help you think it through as well. So scenario number 1, which is in blue, we did it, right? So unwinding of shocks should push inflation down. Supply bottlenecks have gone. We've got less tight labour market now, and we've got weaker pay and price settling dynamics already. That's already starting to show, and inflationary pressures will dissipate without having to have a restrictive policy, a high policy rate for a very long period of time. So this is the kind of dovish scenario, which is basically the victory lap. We did it, soft landing, hurrah. Scenario number 2 is a little bit more painful, because here I've called it no pain, no gain. The idea is that you've got a period of economic slack which is going to be required. What that means in practical terms is below trend growth, below potential growth for the UK, or the labour market eases further, and that means people potentially losing their jobs. Certainly less. The ratio of openings to unemployed people would fall. So a tighter labour market will go from tight to looser, but it'll take a lot more loosening to get inflation to come down. So inflationary persistence will fade eventually, but it's going to require some slack in the economy to get there. And that means we'll need more restrictive policy to squash demand down. Now, the third scenario is in red, which I've called hit me with your policy stick, which is actually a reference to Ian Dury, hit me with your rhythm stick, which none of you will remember unless you're as old as me. But the idea here is that this is going to be the most restrictive policy measure of all. This is going to be what's required. So the idea here is that we've got structural shifts in the economy. So in other words, having gone through this shock of high inflation, people are just used to negotiating higher wages now, and are expecting, companies as well, are expecting to have this ability to negotiate prices upwards. So the price of goods in shops will go up, the price of services will go up, and people will negotiate higher wages. And that'll continue in the system unless it's really squashed out of the system by Andrew Bailey and his high policy rate stick. So that's the most restrictive of all. And hopefully we don't have to do that. Hopefully it is more like 1 than 3. But these are the 3 different scenarios which the Bank of England's considering, based on what Ben Bernanke told them to do. Less of the fan charts, more of these scenarios. So as they talk through these monetary policy meetings, presumably they're kind of thinking in terms of these 3 scenarios and maybe others. But I think it's interesting to couch things that way. Back to reading. I won't make you read that. But there were other things in the report which I think were interesting, which I'll just highlight now. There was a downgrade of GDP growth. So there wasn't a lot of data that came out since the August policy change. But they did say that bank staff now expect a GDP growth of 0.3% in the third quarter of this year, slightly below what they expected previously, which was 0.4%. So weaker growth. And they also gauge growth by talking to the bank's agents, who are just people who report back to the Bank of England about what's happening in the real world, just to ground their beliefs. And that suggests that improving real incomes, also the August bank rate reduction and anticipated further cuts in interest rates had underpinned improved sentiment and expectations of increased activity across most sectors. So even though the outlook is actually a bit weaker now from the bank, they say that the rate cut and improving real income, and we'll look at wage growth in a second, and expectations of further cuts were increasing optimism about the future. So kind of mixed picture there, I think, but not abject despair. So, I still think the UK economy, certainly what's priced into equity markets, is a little bit too dismal, even having seen this data and seen this monetary policy decision. Now, it's always interesting to hear about the disagreements at the central bank. And, if they all agree with each other, it's all quite boring. But there was a range of views, apparently, amongst the members of the MPC, the 9 members, on the degree to which 3 things are in existence in the UK economy. The first one is unwinding of past global shocks. How much of the supply chain disruption is still there? How much of other dynamics which pushed up wages, like potentially higher energy prices, are going to persist? Clearly energy prices are now low, but could they spike again, I guess, is a worry. Also the normalisation of inflation expectations, because if people expect inflation to be higher, people and companies, then that'll affect their behaviour and become a self-fulfilling prophecy. So inflation anchoring is really important when it comes to inflation dynamics. Do people believe inflation's falling? Do they believe the central bank is credible? And if they do think the central bank is credible, then they won't anchor inflation expectations high. So there was disagreement amongst the members about how anchored inflation expectations were. And then finally, whether the current stance of monetary policy, 5%, is sufficiently restrictive. Is it restrictive enough to get inflation down, given those 3 scenarios? So those were the disagreements, whether those 3 factors were, which one was winning. And what was interesting is they summarise it. They say, despite these differences of view, the currency policy stance was judged to be appropriate. Everything's fine. It is restrictive enough. For most members, not all, in the absence of material developments, a gradual approach to removing policy constraint would be warranted. So gradual. So they can wait and see. There isn't a crisis in the economy, not yet. Unemployment, if you actually look at it, ticked downwards, which was good news. Like the Fed, we haven't seen a big pickup in unemployment, and we have got what looks like a soft landing, albeit not as soft as the US. But that means they can wait and see, and also probably wait until they see what the government's going to do with its fiscal plans in October. So that's their mode currently, wait and see, and hopefully things will abate on their own. Now, if you do have a mortgage, the question we're often asked is, should I fix my mortgage now or wait? Well, if you had waited, you'd have waited in vain. These are the 2-year fixed rate mortgage rates from the Bank of England, the latest data. And you can see that the loan to value is very important. So 95% mortgages, you get a higher rate than 60% loan to value. But they haven't come down a lot, it's got to be said. And that's surprising for some people. People often assume that they can forecast these rates, but I don't think you can. Even if the policy rate comes down, it may be that the mortgage rates come down with a lag, because it's a different part of the curve. It's a 2-year swap rate, the 5-year swap rate, which drives these mortgage rates, because that's what the banks use to lay off the risk. And I don't think it's the case that these are coming down very quickly. So the pain is that the Bank of England's going to do a gradual rate cut path, and that means that these also probably won't come down very quickly. So you'll have to wait probably quite a long time to get more reasonable fixed rates in the UK, it looks like, based on what they're currently saying and based on the current data, largely because of that sticky services inflation number that we saw. So that's it. That's my summary, at least. I hope that was kind of helpful. We will have to wait to see what happens with the budget, I think, in order to get more clarity from the Bank of England. We will get a press conference, which I will watch and summarise for you in November. And at this point, I shall summon my dog while you think of some questions. And hopefully Teddy will come up and have a treat. Now, if you do support us on YouTube, then we'll push you to the front of the queue for the questions. If you do a super chat, we appreciate it because it helps us, obviously. And do like and subscribe. I should have said that earlier. I'm sure Laura told me to and I forgot. Yes, like and subscribe. She always puts that in the notes. I always forget to say. I'm not a very good YouTuber. Oh, here he is. Hello. Should give you a nice one as well. Those aren't your favourite. These are the low-fat treats. He hates those. Gets those in the morning. But then when we do tricks, oh yeah, these have got a bit more fat in them. Now you're going to do your stand. Ooh, 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 ooh. You can stand. You can stand. Oh, very good standing. Good boy. Oh, he's very good. Is that all? You're going to go down? You're going to get some treats off Laura. She's got biltong. Go for the biltong. Go on. I can't hear it either. He's just looking around now. I think she's... Yeah, go on. Go and get the biltong. He's a good boy. There we are. So yeah, if you have a question, please do ask. Anything to do with investment, finance, that kind of thing, policy, the economy, any of that's fine. And I'll do my best to answer. Gavin Lawrence says, howdy all. Luke says, money supply is contracting. Kieran Cookery died Moros says, surprising decision to me, to be honest, although I wasn't following the BOE nearly as closely as the Fed. I think we'll wait for Bank of Canada to do the first cut again. Okay, before the UK. Stocks flying today. Yes, my UK small cap portfolio is certainly doing well. So mid caps in the UK are just storming upwards, which is great news. Because the direction of travel is downwards, and usually for small caps, mid caps, that's good news. So yeah, I'm very happy about my small cap UK quality value momentum portfolio. That's going to benefit, I think. What else we got? I guess I'll be holding on to my bonds for a bit longer. Okay. Well, look, the reason you buy bonds isn't because, usually, I don't think it's because you're taking a punt on rate. At least that's not why I buy them. I buy it as kind of dry powder and I hold them to maturity. So you don't have to buy them as a speculative trade. You can always hold on to them to maturity, whatever happens. The way I see it is that it's very difficult to forecast which way the yield curve's moving because so much is already priced in. If you look at the 2-year point, for example, on the UK yield curve, it's already moving down in anticipation of future rate cuts. So a lot is priced into the curve already. And to make money with fixed income, you've got to correctly call the surprises, not what's priced in, which is really tricky second order thinking, I think. Plus, even if you get it right, you don't make a huge profit usually. So that's, I don't usually try to second guess these things. Gavin Lawrence says no conference. Boo. Yeah, I agree with that. I wish they would do a conference every time. I think it would be a lot better. I think more information is probably better than less, and greater transparency is usually a good thing. Is that total sovereign debt? UK trueflation rate 3.18. Yeah, I don't really drink the Kool-Aid of trueflation. Look, inflation rates are subjective. I agree with that. And there are problems with the data. In fact, let me just read you something from the MPC's report, which was interesting. Because they were talking about the unemployment data, which is obviously very important to their policy decision. And it's the LFS, the Labour Force Survey. So they say very low achieved sample sizes meant that the Labour Force Survey based estimates of labour market dynamics remained subject to considerable uncertainties. So it's like they're flying with one of their instruments kind of shot out. That's the kind of situation the Bank of England's in. So it made it difficult to gauge the underlying state of the labour market. But they do use a wide range of data to make judgments about the labour market, including official data, business surveys, and of course stuff from the Bank of England's bank agents. There we go. So they don't rely on that completely, but still it would be nice to have more reliable data. But inflation, I don't think is the problem. That one, inflation surveys, the inflation basket, which they monitor regularly, that hasn't been disrupted. So I think the inflation number's more reliable. But to some extent, inflation is subjective. That's simply true. If you consume different things from the inflation basket, which we all do, then you're going to have a different rate of inflation which you perceive. Generally, poorer families spend more on energy and food. More wealthy families spend more on leisure and other things like mortgages and other expenses. So really your kind of wealth, your income affects your consumption basket, and that affects the rate of inflation which you feel. So it is just an average for the UK, but I think it's a useful average, and I think it's as well estimated as it can be. But trueflation, yeah, I don't really pay much attention to it, to be honest. But look, even that's at 3.2. It's come down massively, whereas the official number's at 2.2. And if we look at even services inflation, that's at 3.6. So core CPI is at 3.6. Services is at 5.6. So that's the one that's really worth paying attention to, not trueflation. Pay attention to what the bank focuses on, because that's what matters. It affects the MPC's decisions and it will affect your investments too. Whereas trueflation, I don't think many people look at it, except for conspiracy theorists. Is that total sovereign debt or just the deficit? The form seems impossible. Not sure what you're talking about there. Yeah, do we have any super chats? Yes, we do. So Philip C, thank you, has a super chat. For someone in drawdown, so that means they've gone into their pension years and they've started selling things to have an income. So for someone in drawdown, would you recommend 80% global ETF and 20% gilts, or 80% global and 20% ERNS, which is a a money market fund. I'm 45 and I want to retire. My plan is to withdraw 3%. I don't think there's a right answer for that. I think it really depends on what your risk appetite is, what your risk capacity is, what your investment horizon is, and the amount you've got invested relative to your income. But if you can withdraw 3% and live off that, I'm presuming you've got a fairly large amount of savings, or your income requirements are fairly limited. Maybe you've got other sources of income. But if that's the case, then you don't potentially need a huge amount of return. So 80% global ETF and 20% gilts would be okay, because it's mostly equity, and that'll give you that 6% average above inflation return. But really you're talking about the safe bucket, whether it should be a money market fund or gilts. And really the question is about lock-in rates. Now, currently the term premium is not huge. So let's have a look at the term premium, what little of it there is. Well, there isn't any. PensionCraft.com, and we'll look at the trackers, and we'll look at the tracker. Yeah, so share. So this is what you get as a member of PensionCraft. This is your dashboard, which has all our upcoming stuff. We've got a content directory. You can watch our YouTube videos with no advertisements in them. We've got a content directory, and we've got trackers. So let's have a look at the trackers, and we'll look at the yield curve, and that's in the macroeconomic tracker. Let me move my head. Right. So this is the yield curve as of yesterday's close, which my colleague Patrick Haddo calculates every day. We'll get there. And at the moment, what we're seeing is a kind of kink in the yield curve, you'll see. So this is each individual bond with maturities between a few months and all the way up to 50 years, the 60 or so UK gilts. And notice how if you're earning 5%, actually 4.95 with Sonia, with a money market fund like Earns, you'll be earning more than any of the yields on the yield curve right now. The highest yield currently, as of yesterday's close, was TR25. This is the bond that matures on March the 7th next year, and the yield on that was 4.5%. So considerably lower than you'd get with Earns, for example, assuming Earns earns the Sonia rate. Now Earns is not one of the ones which is an accumulation money market fund. I usually look at those because they don't have this kind of rampy shape, but things like CSH2 don't have the rampy shape because they're accumulation funds. But at the moment, it's still the case that I'd say it's not worth locking in a rate at the short end of the curve, because it's still better staying in a money market fund. And we've heard from Bailey and others that the rate of cuts is going to be very gradual. So I think you've still got time to wait until we lock in a rate. I think also what will be interesting is what the government says about their spending plans, because remember what happens if the government suddenly says, actually we said we weren't going to increase debt relative to our 5-year forecast, such that it comes down over our 5-year forecast, which is a fairly arbitrary thing anyway. If they twist the rules slightly so there's more issuance means more supply of bonds. More supply of bonds means the prices are lower, and that means the yields are higher. So I think we might well see the belly of the curve here increase as the Bank of England, the Debt Management Office announces that it's going to have to issue more debt to plug the gap in government finances. Because there's no way you can engineer growth in the UK with just changes in planning, right? That's just not going to happen. We can't have more austerity. That's going to be growth negative. So something's going to have to give, and I think it's going to be the debt dynamics, personally. So if that does happen, if they have more issuance and they choose to do it at the 5-year part of the curve, then I'd expect to see that kink kind of to move upwards, and we can lock in better rates. So at that point, I think it could be more attractive to buy gilts. But certainly at the moment, this huge dip up to 5 years means that I wouldn't be buying gilts, 5-year gilts right now. If you're willing to go out to, say, I don't know, 15 years, you're getting better yields. But frankly, I'd stick at the short end of the curve if you have to buy gilts. But other than that, I wouldn't lock it in at the moment. So I hope that answers your question, your super chat question. Thank you for the super chat. Please do like and subscribe. I didn't say it at the beginning, so I'll say it now. And also listen to our podcast, because I mentioned it yesterday when I was talking about the Fed, but I'll mention it again today. So I'll go to youtube.com/@ Many Happy Returns podcast. I got it right. Here we go. So I always struggle with this URL. Just so you can see the URL, I'll make that, I can't make the text larger. So it's youtube.com/@ Many Happy Returns podcast. So if we look at the latest podcast, it's about smart ways to stash your cash, banks, bonds and money market funds. And yes, we talked about premium bonds, which neither Michael nor I are particularly keen on. Although there was a specific set of circumstances which Michael pointed out, which might make them interesting, but personally I'd never buy them. But money market funds, that kind of thing, we talked about that at length, whether banks are safe, that kind of thing. So an interesting episode at the moment, given what's happening with monetary policy. So please do have a listen to that. And also subscribe on YouTube, because that way we'll get more subscribers on YouTube, and we can hopefully think about switching to videos, and I think those would be quite cool for the podcast. So back to your questions, and we'll give it another 5 minutes if you've got questions, and please do super chat, I'd appreciate it, but I will answer questions. Gavin Lawrence, interesting, he says, I'm really worried about Reeves at Treasury. She's a deeply dogmatic and myopic woman. Okay, well, I think her background is such that she's very cautious by nature, and she's very keen on showing this government to be responsible, because I think that Labour learnt the wrong lesson from the Kwarteng Trust budget. The lesson they learnt was that you've got to be really brutally disciplined about keeping the debt to GDP at or below where it is now. I don't think that's true. I think markets would be a bit forgiving about a bit more spending, as long as it was growth positive spending, rather than just handing out tax cuts, which is what we saw previously. So I think that's a problem, and I think there isn't an easy solution for it. The kind of brave decisions which a government has to make would be some kind of change in the debt dynamics, finding some workaround, or just getting rid of it altogether temporarily, but while not kind of spending irresponsibly, of course. But I don't think markets would balk at that, because the prospect of future growth, if it did sound plausible, the plans on infrastructure or whatever they chose to spend it on, I'm not sure that we'd see the bond market choke on those plans. It won't be anything like we saw during the Truss Kwarteng budget, I don't think. But yeah, I think the Labour made a huge mistake with that decision. But we'll see if they change their story. Another super chat. Thank you. Oh no, we've already done that one. Okay. Does it make sense to sell a position? This is from Martin. Does it make sense to sell a position which has only had small returns, 5%, which is bought as a lump sum, to instead dollar cost average the money into the market in the next couple of years? Well, lump sum investing usually is best. So just leaving things alone is usually the better thing to do. Plus, it's less mentally onerous, I think, just leaving things alone. And, markets are very unpredictable. They're quite fickle. They kind of just trend sideways for a long period of time, and then suddenly, seemingly for no reason, they surge upwards. And I doubt you can forecast when that's going to happen. So that's why I think it's best to just stay invested. And if you are drip feeding, the risk is that markets rip upwards while you're drip feeding and you're left, nursing a cash pile which is underperforming. So the problem, I think, with drip feeding is that people may actually slow down their drip feed as markets gradually move downwards rather than accelerate. And that's a worry, because what you should do is really be strict about being fully invested at the end of the period. So the execution of drip feeds is just very difficult. It's beset with psychological problems, sticking to it, suffering through the angst of thinking, have I done the right thing? Whereas if you just put it into markets and leave it, there's just less worry and less cost as well, because you don't have to repeatedly buy. So personally, I just keep it where it is, unless it's a chronically underperforming investment like cash. Cash is earning about 5% currently, but I assume what you're talking about is equity. Someone says you have to pay income tax on a money market fund. That's right. So if you're comparing it with gilt yields outside a SIP or an ISA, then the gilts are more attractive because you don't have to pay capital gains tax on them. So choosing low coupon gilts for money held outside an ISA or a SIP is actually a very tax effective way of parking your money safely and getting a reasonable rate of return with very little tax to pay on it at the moment. There's a question from TK Munns, who says, what timeframes correspond to the belly of the curve and the ideal rate? Not sure what ideal rate is. I probably misread that. But let me show you the curve. So the belly usually is around the 7 to 10 year point on the curve. So the short end is 0 to 5. The belly's kind of 7 to 10, maybe up to 12. And then beyond about 15 is the long end. And you can see the rate at the long end currently is around 4.2. You might see that go up to maybe 5. That's the kind of average long-term yield. And then the short end will move down to about 3. And then you'll end up with a kind of upward sloping yield curve. That would be what you'd normally expect to see. And the belly's just kind of like the hinterland between the two. The short end controlled by the central bank, the long end controlled by growth and inflation expectations. And the belly just gets dragged up and down according to those two moving parts primarily. But those are the kind of bits of the curve and their drivers. But back to your questions, and we've got one. How does I'm not sure what that means. Okay. Gavin Lawrence again. He says they've certainly not laid out anything that looks to encourage growth. Not yet. Crimping North Sea oil and gas exploration. No cuts to corporation tax. No cuts to stamp duty. Yes, stamp duty would be an obvious one. I'm talking about stamp duty reserve tax in the stock market. That would have been a positive. No raise in personal allowance. Yeah. And any money saved, winter fuel, hasn't been earmarked for extinguishing expensive debt. In fact, if cutting winter fuel saves approximately 10 billion, debt interest per month is approximately 67 billion, because we have a lot of inflation-linked debt, and that's also become very expensive to service. So I think they inherited a bad hand, that's true, but I think being really Eeyore-ish about the economy and talking about the black hole is just not the way to solve the problem. I think being a bit upbeat is actually helpful, because that would encourage foreign investors to invest in the UK. But if it's all doom and gloom, then who's going to want to invest in the UK if that's all they hear from the government, which is supposed to be the cheerleader for the economy? I think that's quite disappointing. So the early scores for the Labour government, not great from my point of view. Hopefully they'll come up with something good in the budget. We'll have to wait and see. GB Energy, yeah, that's kind of positive, I think. If there was some kind of huge spending plan to create UK energy infrastructure that would stimulate the economy. It would also put us on a more energy independent footing, having not depending on dictatorships around the world to sell us their fossil fuels. And to be fair, it is almost exclusively governments which are not aligned with our way of thinking in the West, which generate the oil. So having the energy independence removes that dependence politically, and I think that would be a big benefit for the UK. And if there is an energy price shock, we wouldn't be so dependent on that, and it wouldn't so negatively impact the UK. So I think weaning ourselves off energy dependence and fossil fuel dependence sooner rather than later will pay dividends down the road. So I think, the GB Energy thing, if they execute it effectively, could be quite a positive. But we'll just have to see what the execution is. Did you get any market crash shopping done before the rally today? I mean, I when Laura tells me I can spend money on my pension, I put money into the pension. So it's not, the timing is not driven by me. But I did create my copper pie on Trading 212 for copper miners, and it's kind of been down and up. And the small cap value quality momentum portfolio also down and up over the last couple of months. But it's above where it started, so I'm kind of happy with that. But no big purchases, because there wasn't really a crash. There wasn't much of a fall. If there was a big crash in the copper pie, for example, I would buy more of that, because that is a long-term play. So is the UK pie. So all of those. If there was a big fall, I would invest more, but there wasn't. Right. So I've still got a lot of dry powder. About 10% of my investments is in money market funds. So I'm ready, if there is a big sell-off, to buy more risky assets. But we really haven't seen a big sell-off for some time. We've just seen markets trading sideways. And what else do we have? That's about it, I think. I think we can probably draw a line under it there. Thank you for joining us. Thank you for listening. And thank you for your questions. And don't forget, you can join our community. Just go to pensioncraft.com/membership. You get access to the trackers. You can have one-to-one sessions with me, and then we'll spend an hour together. Again, to find that, just go to pensioncraft.com/coaching and listen to our podcast and subscribe to it, because Michael does a cracking job of stopping me from rambling, structuring the discussions, creating really interesting topics, I think, and he comes up with it week after week, and they're just getting better and better. Michael's great. So do subscribe, youtube.com/@manyhappyreturnspodcast to subscribe for that. How to Stash Your Cash, which was this week's episode. Have a listen to that. And thank you for joining us.